Starvation or death, the ancient trap. For thousands of years, human survival depended on a single, non-negotiable rule: action. When our ancestors heard a twig snap in the forest, they didn't sit back to analyze the data. They didn't look for confirmation. They ran. If they saw food, they ate it immediately. It was binary: starvation or death. Hesitation didn't just mean a missed opportunity. It meant you didn't survive the night. But here is the cruel irony of the modern financial world. That exact biological wiring, the instinct that kept us alive and wild, is now the greatest enemy to your wealth. Welcome to the trading paradox. In the wild, action is survival. In the markets, action is often suicide. Every impulse that screams at you to do something is a remnant of an ancient system that has no place in your trading station. Consider the typical day trader. His eyes are glued to level 2 data. His finger is hovering over the mouse, vibrating with tension. He is ready to pounce on the slightest momentum shift. He feels productive. He feels engaged. He feels alive. Yet statistically, he is hemorrhaging capital at an alarming rate. Meanwhile, the patient trader sits back, observes market structure, and does absolutely nothing until the math is overwhelmingly in her favor. Today, we are going to deconstruct why your brain is wired to lose money and how the top 1% of traders flip the script to turn doing nothing into their most profitable strategy. The silent tax, the mathematics of impatience. Most traders believe they lose money because they don't know enough technical analysis. They think if they just learn one more indicator, one more pattern, they will become profitable. But the truth is much simpler and much more painful. You are likely losing because of the silent tax. Impatience in trading operates like a silent tax on your portfolio. Every premature entry, every position driven by FOMO, every just this once deviation from your trading plan compounds into catastrophic losses over time. Let's strip away the emotion and look at the mathematics of impatience. Imagine an impulsive trader. Let's call him Trader A. He feels the need to be in the market to make money. He takes 20 setups a week. These are low probability setups. Maybe they look okay, but they aren't great. He risks 1% per trade. By taking 20 marginal trades, he exposes his portfolio to 20% total risk for a marginal expected value. He is flipping coins and paying commissions for the privilege. Now, look at the patient trader, Trader B. Over that same period, she sits on her hands. She watches the same market, but she sees nothing that fits her A+ criteria. Finally, on Thursday and Friday, she spots 3 high conviction plays. She risks the same 1% per trade. Her total risk exposure is only 3%. Yet, because she waited for the perfect confluence of factors, her probability of winning is significantly higher, and her risk-to-reward ratio is far superior. This is what most people miss. The bid-ask spread alone punishes overtrading mercilessly. Add in commission slippage and the immense psychological toll of making constant decisions, and impatience becomes the fastest route to account depletion. Active waiting, the sniper versus the machine gunner. Here is where most traders completely misunderstand the concept of patience. They confuse patience with passivity. They think waiting means being lazy, staring blankly at a screen, or walking away entirely. Let me be clear. Professional patience is intensely active. Think of a military sniper. Before they take a single shot, they spend hours, sometimes days, in absolute stillness. But are they doing nothing? No. They are assessing wind speed. They are calculating distance. They are monitoring the environment for changes in light and shadow. They are waiting for the target to move into the perfect window. In trading, this is called active waiting. While the amateur is frantically clicking buttons like a machine gunner, spraying bullets, making noise, wasting ammunition, and revealing their position, the professional is in sniper mode. Active waiting involves continuous chart analysis across multiple time frames. It means tracking institutional order flow and dark pool activity. It means monitoring economic catalysts and sector rotation. It involves maintaining strict journal discipline and preparing for various market scenarios. The patient trader isn't idle. They are loading the chamber. They are preparing for maximum impact so that when opportunity finally arrives, the execution is effortless. The compound effect of disciplined patience. Warren Buffett's famous quote rings especially true in active trading. The stock market is a device for transferring money from the impatient to the patient. This isn't just a nice piece of investment philosophy. It is a mathematical reality. Patient traders naturally develop higher win rates because they have stricter entry criteria. They experience lower maximum drawdowns because they avoid the marginal setups that usually lead to losses. But most importantly, they preserve their mental capital. Mental capital is just as important as financial capital. Every trade you take drains your focus and emotional resilience. If you exhaust your mental capital on market noise at 9:30 a.m., you won't have the clarity or confidence to pull the trigger on the genuine breakout at 2 p.m. Let's run a theoretical scenario. Consider two traders starting with $50,000. Trader A takes 200 trades annually. He has a 55% accuracy rate and a 1.2 to 1 risk-reward ratio. Trader B takes only 50 carefully selected trades. She has a 65% accuracy rate and a 2 to 1 risk-reward ratio. Despite taking 75% fewer trades, Trader B will significantly outperform Trader A. Why? Because Trader A is churning his account, fighting the spread, and dealing with the stress of 200 decisions. Trader B is calm, collected, and profitable. She understands that in trading, less is often exponentially more. Overcoming action addiction, the casino environment. We have to address the environment you are working in. Trading platforms are not neutral tools. They are engineered to encourage activity. Flashing prices, changing colors, one-click execution, gamified interfaces. These are designed to trigger the same dopamine receptors as a slot machine. They create an environment designed to trigger impulsive behavior. They want you to trade. They want you to churn. Recognizing this manipulation is a first step toward liberation. Successful traders develop what I call strategic boredom tolerance. They embrace the silence between setups as productive time, not wasted opportunity. This mindset shift transforms trading from reactive gambling into proactive business management. If you own a high-end boutique, you wouldn't run out into the street and force people to buy your clothes just because the shop was empty for an hour. You would wait. You would organize your inventory. You would prepare for the customer who actually wants to buy. Why do you treat your trading business any differently? Why do you force a trade when the market is offering you nothing? Market structure, the 70-30 rule. Understanding market microstructure reveals exactly why patience pays so well. Markets are not efficient engines of constant movement. In fact, markets spend roughly 70% of their time in consolidation patterns, ranging, chopping, and sideways movement. Only about 30% of the time is the market in a trending move where substantial profits exist. The 70% consolidation phase is the graveyard of impatient traders. This is where the amateurs waste their ammunition. They get chopped up trying to predict a breakout that hasn't happened yet. They buy the top of the range and sell the bottom. They get frustrated. Professional traders recognize these accumulation and distribution phases. They are willing to wait. They understand that missing the first 20% of a move while confirming the direction is far superior to catching a falling knife. When you try to catch the exact bottom or the exact top, you are gambling. When you wait for the market to show its hand, you are trading. The psychology of doing nothing. The most profitable trading days often involve zero transactions. This concept violates every cultural expectation we have about work. We are taught that money comes from effort. If you want to make more, you work harder. You dig more ditches, you write more emails, you make more calls. In trading, this correlation is broken. In trading, working harder usually means overtrading and losing money. Learning to celebrate the trades you don't take requires a fundamental psychological rewiring. You need to create new success metrics for yourself. Instead of looking at your P&L at the end of the day, look at your adherence to your rules. Did you follow your plan? Did you wait for the setup? Did you stay out of the chop? If you sat on your hands for 6 hours because your criteria weren't met, that is a successful trading day. You protected your capital. You survived. Common patience pitfalls. Now a warning. There are pitfalls to this approach. Many traders mistake analysis paralysis for patience. True patience involves clear decision criteria and decisive action when those criteria are met. Hesitation in the face of a valid setup is fear, not patience. Another pitfall is perfectionism. You might find yourself waiting for the perfect setup that never materializes. Patience means waiting for good enough, according to your plan, not waiting for a fantasy. And finally, there's the waiting reward system. The market will periodically offer you gift setups, obvious opportunities with minimal risk and substantial reward. These setups are the payment for your patience. But if you have depleted your mental capital or your actual account balance by overtrading the noise, you'll be unable to capitalize on the gift when it arrives. That is the ultimate trading tragedy. Being broke when the opportunity of a lifetime walks through the door. Building your patience muscle. Patience is not a personality trait. It is a muscle. It develops through deliberate practice. You cannot wish yourself to be more patient. You must train for it. Start by extending your typical holding periods. If you usually scalp for minutes, force yourself to analyze the hourly charts. If you typically trade the hourly, look at the daily. Implement cooling-off periods. If you take a loss, mandate a minimum wait time before you can enter the next trade. Maybe 30 minutes, maybe an hour. These artificial constraints build natural patience over time. Adopt the professional mindset. View trading as a probability game extended over thousands of trades. When you look at a single trade, it feels important. When you look at the next 1,000 trades, one individual outcome is irrelevant. Process adherence is everything. This long-term perspective naturally cultivates patience. You realize that capital preservation is profit. Every avoided loss is earned money. This reframing makes patience profitable rather than painful. Conclusion, the ultimate edge. In a world of high-frequency algorithms and split-second execution, individual trader advantages seem impossible. The computers are faster than you. They can process data in nanoseconds. They don't get tired. But you have one edge that technology cannot replicate. You have the ability to do nothing. Algorithms must trade to provide liquidity. Funds must trade to show activity to investors. You don't have to do anything. You can stand aside. You can wait for the storm to pass. You can wait for the setup to be so perfect it feels like cheating. Your patience is your alpha. Your discipline is your differentiation. Your ability to sit still while others panic, to remain calm while others are frantic, is your pathway to consistent profitability. The market will always be there. It will always offer opportunities. The question is not whether the market is ready for you, but whether you are disciplined enough to wait for the market. Master the art of waiting, and you master the markets.